On June 25th, 2025, something remarkable happened that barely made the headlines. The Federal Housing Finance Agency, the same regulator overseeing Fannie Mae and Freddie Mac, issued a directive that could change the way cryptocurrency is treated in the world of traditional finance. The directive instructs Fannie and Freddie, who back about half of the $12 trillion U.S. mortgage market, to explore accepting cryptocurrency as part of the mortgage qualification process. But not just any crypto. Only assets held on U.S. regulated centralized exchanges like Coinbase or Kraken. Self-custodied Bitcoin? That's excluded, at least for now. This is the first time a major U.S. housing authority has seriously entertained crypto as a qualifying financial asset. And whether you're a crypto investor or a critic of government overreach, this development matters. For investors, this signals growing institutional legitimacy, and that legitimacy already seems to be fueling demand. Bitcoin surged above $105,000 in June of this year, not long after this announcement. But for skeptics, especially those who've been around since the 2008 financial crisis, this move raises major red flags. Because once again, we're watching a system invite in volatility, rely on centralized intermediaries, and ignore some of the most important lessons of the last housing collapse. So in this video, we're going to look at both sides, the opportunities this creates for crypto adoption and the risks it brings, particularly for anyone who values decentralization, transparency, and true financial independence. So what exactly does this directive say? So at its core, the FHFA is asking Fannie Mae and Freddie Mac to propose risk models for evaluating cryptocurrencies held on U.S. regulated exchanges. These models would help determine whether someone's crypto holdings can count toward their financial profile when applying for a mortgage. But here's the catch. It only applies to crypto held on centralized exchanges that are fully compliant with US regulation. That means if you're self-custodying your assets, keeping your Bitcoin on cold storage, managing your own keys, you're excluded from this policy. Only assets held under custodial control count, and that's the first red flag. Right now, there's no set timeline. Fannie and Freddie are in the proposal stage, and any framework they develop still needs FHFA approval. But even at this early point, the potential implications are huge. For investors, this opens a major opportunity. Crypto holders could now use their digital assets as collateral or proof of financial stability without having to sell them and trigger a taxable event. That's a big deal, especially in a world where capital gains can eat into long-term strategies. It adds utility to holding crypto, especially Bitcoin and Ethereum, and it creates another narrative for adoption. But here's the issue for government skeptics, and frankly, for anyone who understands why crypto was created in the first place. This entire proposal is built around custodial infrastructure. Instead of leveraging blockchain's native transparency, it reintroduces third-party intermediaries as gatekeepers. Think about that. The whole point of crypto was to remove middlemen. Now, the system is being redesigned to depend on them again, and not just for custody, but for verification, compliance, and risk assessment. Now, if that sounds familiar, it should. It's exactly the kind of blind trust in opaque institutions that contributed to the last housing crisis. And if we're not careful, we could be watching history repeat itself, this time with digital assets. Now, to really understand the potential risks here, we need to zoom out and look at history, specifically the 2008 global financial crisis. Back then, financial innovation took the form of subprime mortgages and exotic derivatives, things like mortgage-backed securities and CDOs. They were sold as safe, sophisticated tools that would expand access to credit and boost the housing market. Sound familiar? Well, today crypto is stepping into that same narrative. But here's the problem. Like those subprime instruments, crypto is volatile. In February 2025 alone, Bitcoin dropped 16% in just 1 week. Imagine a borrower qualifying for a mortgage based on crypto holdings only to see their asset tank mid-process. That kind of instability could ripple through the housing market if not tightly managed. And then there's the issue of reliance on intermediaries. In 2008, rating agencies were supposed to evaluate risk objectively, but they didn't. Their flawed models helped fuel reckless lending. The same pattern is repeating now, except instead of rating agencies, we have custodians. Coinbase, Kraken, whoever is holding your crypto for you. These platforms will be tasked with verifying holdings for Fannie and Freddie. But what happens when one of them suffers a breach or worse, an FTX-style collapse altogether? The risks are real. The directive treats these custodians as if they're fail-proof, but they're not. And building a mortgage framework on top of them reintroduces counterparty risk that crypto was designed to eliminate. And let's talk about moral hazard. In 2008, Fannie and Freddie issued massive amounts of risky loans under the assumption that the government would bail them out if things went sideways. And that's exactly what happened. Nearly $200 billion in taxpayer funds were used to keep them afloat. Now in 2025, we're seeing another pattern emerge. Pro-crypto policy moves are gaining traction. Trump's strategic Bitcoin reserve plan, for example, and regulators are signaling support for digital assets. But there are red flags. Potential conflicts of interest, like the FHFA director's spouse reportedly holding up to $1 million in crypto. If the system bends policy to accommodate the market without proper risk controls, we're right back in 2008 territory. Even worse, legal clarity is still lacking. Only about half of US states have adopted Article 12 of the Uniform Commercial Code, which governs digital asset rights. This means, in many jurisdictions, there's no legal foundation for what happens if something goes wrong. So for crypto investors, the upside is real. Policy support, increased utility, and potential price appreciation. But for those who lived through the last financial crisis, the warning signs are hard to ignore. Let's look at what's happened since the FHFA's directive was announced and what it signals for both investors and skeptics. First, the industry reaction. According to Housing Wire, most lenders don't expect immediate changes for conventional mortgage borrowers. But for those in the non-qualified mortgage space, self-employed individuals, crypto-rich investors, this could eventually open a new path to home ownership without liquidating assets. That's a win. For investors, this means crypto can start functioning more like traditional collateral, boosting its real-world utility. But skeptics should pay attention to the fine print. The directive only applies to assets held on US-regulated, centralized exchanges. If your Bitcoin is in cold storage, you're excluded. DeFi users? Also excluded. This reinforces a two-tier system, one for those willing to play by the custodial rules and one for those who value true sovereignty. On social media, the crypto community is buzzing. Between June 26th and 27th, Bitcoin Magazine and Michael Saylor both posted enthusiastically about this as a mainstream breakthrough. For investors, this validates long-term conviction, especially for Bitcoin and Ethereum. It could even drive more people to hold assets on platforms like Coinbase just to qualify for a loan. But that excitement also masks a deeper concern. This is being hailed as progress, but it's progress that depends on centralization. The more tightly crypto is bound to traditional finance, the more exposed it becomes to its weaknesses. That's not integration. It's capture. And now let's talk about the implementation challenges. According to CoinGeek, lenders will likely apply a steep haircut on crypto valuations, proposing as much as a 50% discount when factoring crypto into mortgage applications. That's a big deal. If you hold $100,000 worth of Bitcoin, a lender might only count $50,000 towards your qualification. Conservative? Yes, but necessary given the volatility. That kind of model might protect against sharp drawdowns, but it also limits access and introduces subjectivity. We're back to modeling risk like it's 2006. There's also the technical hurdle of verifying ownership without requiring liquidation. And again, only custodial platforms can provide that kind of verification. As of yet. So we're left in a situation where blockchain's native transparency is ignored and third-party intermediaries are trusted instead. The policy context is becoming clearer. On July 8th, the National Mortgage Professional Conference brought together regulators, lenders, and crypto experts to discuss the future of digital assets and AI in housing finance. While no sweeping mandates were announced, the tone was unmistakable. Regulators are serious about integrating crypto into traditional finance on their terms. The event reinforced a growing consensus that any future innovation will come with heavy oversight, favoring platforms and assets that comply with US rules. Now, for investors, these developments could legitimize the market, improve confidence, and increase demand for regulated tokens. But for skeptics, it's a reminder that top-down regulation is steering the future of crypto, at least in the centralized world. And that future looks a lot like the old financial system. No surprise, just wrapped in digital clothing. So what happens next? If you're holding crypto or even just watching this space, the FHFA directive creates both upside potential and systemic uncertainty. For investors, the opportunity is real. If crypto can be used to qualify for a mortgage without liquidation, that does boost utility. It reduces tax burdens, and it could increase overall demand. That's especially true for assets like Bitcoin and Ethereum, which already dominate institutional portfolios. In the short term, this kind of policy support could drive prices higher and reward long-term holders. But the risks are just as important to understand. Crypto's volatility isn't going away, and mortgage approvals could still get derailed mid-process if markets tank. Lenders may apply steep valuation discounts, up to 50% in some cases, to account for this. And then there's the custodial risk. If your eligibility depends on holding with a centralized exchange, you're trusting that platform with your financial future. History has shown us FTX, Celsius, even temporary glitches at Coinbase. These platforms are not infallible. For government skeptics, the core concern is bigger than market swings. It's about systemic fragility. This directive mirrors some of the same patterns that led to the 2008 crisis: reliance on flawed intermediaries, experimental financial products, and weak regulatory clarity. FHFA's plan to use only US regulated exchanges and apply volatility controls might sound prudent, but it hasn't been stress tested. We don't know yet how well these models will hold up under real economic pressure. Still, there are some built-in safeguards. This directive is in a proposal stage, not a rollout. Fannie and Freddie must get approval for any risk models that they do submit. The scope is also limited to select crypto assets on regulated platforms, not self-custody coins or DeFi tokens. That gives the system some breathing room, at least for now. The real wild card is what happens if, or when, a crypto market crash and housing market instability collide. The directive might not trigger 2008 scale crisis on its own, but in a fragile economy, propped up by debt and dependent on trust, even small missteps can have ripple effects. That's why this isn't just a regulatory milestone, it's a stress test for how far the system is willing to integrate crypto without reforming the very foundations that nearly collapsed last time. Whether you're optimistic about this integration or skeptical of where it's headed, now is the time to pay attention. If you're a crypto investor, track how this directive evolves. Watch which exchanges are being accepted, how risk models are applied, and whether lenders start rolling out pilot programs. If you're holding assets you plan to use for a mortgage, consider the implications. Please consider the implications of custodying them, because only assets on US regulated exchanges will qualify, at least for now. And if you're concerned about volatility, diversify. Don't let short-term swings sabotage long-term opportunities. If you're a skeptic, this is your chance to shape the conversation. Push for the inclusion of self-custodied crypto, because blockchain's transparency was meant to reduce risk, not to be ignored. Monitor how Fannie Mae and Freddie Mac and the FHFA develop these frameworks. Demand regulatory clarity that balances innovation with accountability. And for everyone watching, whether you're in crypto for the gains, the tech, or the principles, stay informed, stay sharp, and most importantly, stay sovereign. You can find ongoing coverage, market insights, and educational resources at learningcrypto.com, because understanding what's coming up next isn't just smart, it's necessary. Thanks so much for watching. I'll see you in the next video.